property management is always going to have a reactive piece to it. You're always going to have emergencies. You're always going to have things that need to be done. The real answer, though, to that is a lot of those things don't need to be reactive.
Welcome, everybody. I'm Jason Hull, the founder and CEO of DoorGrow, the world's leading and most comprehensive coaching and consulting firm for long-term residential property management entrepreneurs. For over a decade and a half, we have brought innovative strategies and optimization to the property management industry. At DoorGrow, we are on a mission to transform property management business owners and their businesses. We want to transform the industry, eliminate the BS, build awareness, change perception, expand the market, and help the best property management entrepreneurs win. Now, let's get into the show. All right, so today's episode, I'm hanging out with Ryan Cadwell, managing partner at Resolute RDM, and we're going to dive deep into how property managers can stop operating reactively and start thinking like true asset managers. So, Ryan, welcome to the show.
Thanks, Jason, for having us. We're glad to be here.
Awesome. So Ryan's going to break down, this is our notes, right? So Ryan's going to break down the critical difference between market value and investment value and why understanding that gap is the key to building long-term wealth. And he's going to share why so many investors overpay, how to structure smarter deals that actually increase returns, and the leadership habits that drive sustainable business growth. All right, cool. So let's get into that. So Ryan, I'd love people to get a little bit of background on you, how you got into entrepreneurism and how you got into developing this business and maybe how this connects to property management. And then we'll get into everything.
Sure. Background is we've been in the game for 18 years. Wife and I started it, and we started the overall idea of it in '08. Actually, it was '06 when we were kicking it around, and perfect time to get into all this, '08, right during the financial crisis. Third generation entrepreneur. Both my dad and my grandfather on his side were entrepreneurs. So that's how I got drawn into that world. Originally was going to be just an investor, but my dad had apartments with another business that he ran, and I grew up around it. I was cutting grass and I was around tenants that whole time. So when we were in the investment world and wanting to grow that, in the '08 through 2012 market, I started looking for property managers. I did some interviews.
So, but this started as like kind of, you're in the family business of entrepreneurism, it sounds like. So
yeah, and we could talk about that too, how to work with your family.
Yeah,
how to work with your family and how to get ahead of that too, so that you don't damage the relationships and those kinds of things.
Cool. Well, let's chat about this because, property managers, they are a lot of times reactive. They're just reacting to everything.
Mm-hmm.
I feel like
It's a reactive business.
To react to everything that every tenant calls them, every owner calls them. They're just managing, putting out fires all the time. How do we start getting to think like true asset managers and get them out of this?
I think the goal really is to be an asset manager, because at that point you're planning decisions ahead of time. Property management is always going to have a reactive piece to it. You're always going to have emergencies. You're always going to have things that need to be done. The real answer, though, to that is a lot of those things don't need to be reactive. They could have been planned. Proper expectations could have been set. Having conversations, like the way you onboard, the way you train, you educate, and how you communicate in the time, the times that they're going to receive statements or anything you get on a repeat basis. It just needs to kind of be walked through. Now, if you haven't started your clients out in that, we've learned that the hard way. We've had to kind of modify some of the things when we onboard. So we've got, we have clients that were raised in our old ways that we've had to kind of push out educational pieces, marketing pieces that are, here's how we operate, here's what we do, and send out reminders. Hey, this is when stuff's happening. So to get proactive, you got to start looking at all the things that you do, all the things that they need, and then start educating them ahead of time. And you educate them ahead of time knowing that they're not going to read everything. They're not going to pay attention.
Yeah.
And then you just have a gentle reminder. But our ops staff is way better at this even than I am. I was way more reactive and figuring it out on the fly. And they were always like, there's no reason this is this stressful. How do we get ahead of this? How do we start educating? Your statements will come out on this day. Your payments come out on this day. Here's the way that our system works. If you've got an emergency, here's what to expect. Oh, and by the way, here's what qualifies as an emergency. That's another thing too. But no matter what, it's still a people business. It's still, you're still going to have people that aren't going to necessarily follow all of your patterns. And sometimes you got to decide whether or not that means they stay as a client, or you work on that relationship, see if you can't kind of get them in line. Other times you're going to part ways with that client just because it's going to be better for both of you to do that.
Yeah. So some of the things I'm hearing is like, there's things that could have been planned. So having good planning, setting expectations, having good onboarding, defining what emergencies are, setting boundaries, right?
Yeah.
And if they're not willing to play ball, then firing some clients for sure. Cool. So tell me about what's the difference between market value and investment value? For those listening, I'm doing air quotes. So
Market value and investment value, I think, is the difference in those two terms is where money is made and lost
okay.
every single time. The buyer wants to buy on investment value, and then they want to sell on market value. That gap is truly where a lot of money can be made. Truly, investment value is different for every investor. You have to know what your opportunity cost is. If you didn't put your money into here, where else, how much more can you make? And then evaluate whether or not this deal works for your portfolio. Everybody's money is different. Everybody's opportunities are different. So if you don't know those numbers, you typically just default to market value because appraisers walk in and it's income approach, it's cost approach, and then it's comp approach, right? That's the most common three ways that they value it. And then brokers are going to tell you what, if they're selling for the seller's agent, they're going to tell you usually market value. This is what market is. Even on the bigger stuff, the multifamily stuff, they're always going to be pushing whatever is going to generate the most value for their client.
Right.
For you, you have to know in your underwriting, what can you financially absorb? One of the biggest things going on right now is if you're getting into the market right now, everybody's financial projections are, this is going to be long-term plays. Like the fast money that we just came out of, that's most likely not going to be in the next 5 years, the next 5, 10, 15 years. You can't say always, because there will be some stuff that'll pop. There'll be a few home runs. Most of what's going to happen is going to be fundamentals. It's going to be operational, which means underwriting investment value is going to be key. Because if you're not doing that, you're most likely going to default to, well, if I want to put my money to work in this, I'm going to have to overpay a little bit. And by overpay, I even mean in a negative leverage position where your debt's costing you more than you're getting on your return. And if that's the case, you've got to have enough cash to weather the storm. And
Sure.
there are some people that are doing that. And that's their investment strategy and thesis. But
Like
if you
you mean
don't,
maybe like in the short term, it's not cash flowing, but as an asset or an investment in long term, it's a great play.
yeah, as long as you're in a position to be able to absorb that. I mean, we've run into some owners. We've had, and I think this is the reason why I've come out more and started talking about this is a lot of the relationships where they're strained with our clients is usually when we're brought in after they bought it. We don't know how they underwrote it. They bring it to us and somebody else told them what it's going to rent for. We take it to market. It doesn't rent for that.
Right.
They're in a negative cash flow position and they planned on being positive and having money for reserves. And now they're pulling money out of their paycheck to make sure everything gets paid.
Right. Because they were operating from the beginning with false assumptions or incorrect assumptions. And so the expectations are off. And then you have to be the bearer of bad news, but also you're the person that's finally giving them the truth. And yeah.
And that's hard to be in because it's like spent cost fallacy. It's where they've spent the money on this. They bought into whatever the underwriting was, and they were super excited. There was the emotional attachment, and then they get to where, oh no.
Yeah. Yeah.
And then
Spend
with
cost
us,
fallacy sums up, I think, the whole state of California in how they spend money. So They're like, we bought this. They buy, they're like, they invest all this stuff into metros and buses and whatever. And everybody wants to drive cars. And yeah, like, but we put so much money into this. Yeah.
Right. Yep. Yep. And because we put money into it, therefore it's valid. Yeah.
Right. Yeah. Got it. So we need to understand the difference between market value and investment value. Understand that gap is how we understand long-term wealth, because if the gap's off, it's either profit or loss. That's what the gap is. And so it could go either way. And so we want to make sure there's profitability there. And even if it's in the short term, maybe it's a loss. The long term, it still could be profitable. Maybe it can make sense. Okay. So a lot of investors, they're overpaying. You want to structure smarter deals to increase the returns. And we're also going to chat about the leadership habits that drive sustainable business growth. So where do we go from here, you think?
I mean, I love talking about habits because habits are what good habits and sound habits create sound fundamentals, and it helps avoid a lot of it helps expose a lot more of the mistakes that we can get into.
Yeah.
It helps maintain discipline. It helps expose us. Like if you're getting emotional about a deal, I'm in an investor group, and it's funny when, one of the guys pitches the group a deal, we all kind of have this joke. If it feels emotional to the person, we always poke at that. We always bring that up. Are you emotionally attached to this deal? Like, are you okay walking away? Because you don't want to get money is a very emotional thing. And if you're not honest about it when you're evaluating, it's a good way to get into that.
So Ryan, what I'm hearing is like when you talk about habits, it sounds like you've got some rules, some guidelines that you sort of have learned to follow when it comes to these to make sure this works. And one of these is, reason over emotion is like making sure you're not making this, taking a step back and questioning yourself. Am I emotionally too attached to this, and why? And I mean, I think at the end of the day, every decision we make at some point connects to something that connects to emotion, right? Like, why
Agreed.
do you have investment properties? Well, I want to take care of my family. Cool. Why do you want to take care of your family? Because I want to feel like a good provider. Okay. And what is that? Why is it important to be a good provider? Because I want to feel like I'm doing good in the world, like I'm doing the right thing. So you want to feel good,
Yep.
So ultimately, it always boils down to this feeling. We just got to make sure that we recognize the feeling, because sometimes there's a totally different path to get to that feeling than having that rental property, for example.
100%. I think that right there is probably the number one thing to always remember. It doesn't
Right.
have to be a rental property to accomplish the same goal.
Right. Yeah. So maybe just working it backwards to figure out, well, why do I think I want these investments? Well, I want to invest. Well, why do I want to invest? I want more money. Why do you think this is the best vehicle? So if we just question our assumptions all the way down, we'll eventually probably connect to some sort of feeling. Can I get this feeling another way? Can I invest another way? Is this the best vehicle for me to get what I'm trying to achieve? And sometimes it might be yes. Sometimes it might be no.
And there's ways to diversify your portfolio with REIT stocks. Those are attached to the real estate market. Those diversify your portfolio too. Now, I'm not licensed to sell those, so I'm not giving advice. I'm just saying
Explain for newbie investors what restocks are.
REIT stocks are a REIT is a real estate investment trust.
Say
It is
REIT stocks. Okay.
REIT stocks. Yeah.
Okay.
REIT.
I thought you were making
stocks.
something totally new called restocks, like restocking a shelf. So I was like, tell me about this.
Nope, just REIT stocks, just a different way for you to invest. It's more cash, cash in and out because it's a stock. You can, if the market's open, you can trade it, put your
Yeah.
money in, get your money back out. It's not like sitting on a rental house or a rental apartment complex and you've got to wait on the market to show up. And if you got to sell fast, you got to take a bath. All that happens within the entity, but yeah.
Got it. What are some other habits or rules you think are important in these scenarios to follow?
I think it's truly starting from a place of really understanding your financial position. I mean, what's your tax percentage? I've asked some people, they don't actually know. If you don't know how much, if you know how much you're paying annually in taxes, then it makes it harder to plan if you're going to sell and whether to do a 1031 exchange, for instance,
Yeah.
or whether to take the gain. Everybody would normally say, oh, you never want to pay the government. That's not always true. You got to run the numbers. Sometimes Sometimes if you sell, like for instance, when the market was super hot in 22, I would have told you probably need to really reconsider a 1031 because you might be buying peak of the market and you're going to lose way more money than what you would have
And you
paid
can
in
know.
in a gain.
Yeah.
So if you don't know your true financial position, like what is your opportunity cost? If you were to take the same cash you're going to put down and you're going to put it into whether it's savings, bonds, other investment vehicles, what is your average return on that money?
Yeah.
And knowing those numbers, just in knowing them, and then when you look at your next investment, it starts to change the way you think about it because now it's not necessarily am I getting into real estate, am I getting into real estate for the right reason to accomplish the right goal? Because at the end of the day, I think everybody wants real estate for the same reason, and that's to create the biggest pile of money.
Do you think so you got to understand your financial position. Sometimes people see somebody else doing something investment wise, their friends doing it. They're like, maybe I should do it. But what makes sense for them might not make sense for you because your tax situation is different. Your tax liabilities are different. Like the cash on hand is different. Your long term goals might be different, right? Maybe they're at a completely different place than where you're at financially. And you're trying to play like the big boy, but maybe you're not there yet, right? And there's also the factor, though, of you're talking about all these different investments. What do you think about the phrase people say, invest in what you know?
I mean, I preach that all the time. If you don't know it, the only real way to get into it is to partner with somebody who does, who knows it really well. And that usually means they've lost money in it in some way.
Yeah, they've made some mistakes, so you don't have to. Okay.
So partner with somebody who does, or I mean, the easiest example for me has always been something like Apple. Like I think Warren Buffett and Charlie Munger taught the same thing. Like if you already like something, you're probably gonna naturally know market cycles without realizing it. I mean, Apple's easy for me because they have their thing in September, they launch and sell all their new products in October. And then as long as all that goes well, they usually have a price increase December, January. So if you want to go in and out of Apple, that's typically a pretty good up and down. Everything in real estate is very similar. If you like houses and you want to flip, or you like hospitality in houses, that's Airbnb. If, there are things that are going to be where you're not working as much, or things you're naturally retaining information about the market. There's a lot of advantages right now for investors that know their local market and
Uh-huh.
know where there's value. Because some of the big boys are getting out of stuff that they can't run spreadsheets on from New York, California, Florida, wherever they're based. And you're sitting there in the local market, you see what's going on. There's advantages to pulling the trigger on stuff because you're in that market. That is a big thing right now for investors to see value that other people can't, because a lot of the value that was clearly visible, it gets bought up by the people with cheaper money. I mean, to be honest.
Got it. Okay. Well, Ryan, sounds like you've made a few mistakes yourself over the years. You've
Yeah.
learned some things. You have a lot of
Yeah.
knowledge regarding this. You coming and sharing here on the DoorGrow show. How can people maybe get in touch with you if they're curious or want to like learn a little more? Maybe you could tell everyone just a little bit about your business.
Sure. Check us out online, resoluterdm.com, or look me up on LinkedIn. We're also on Facebook, TikTok. We put out videos all the time trying to help everybody. So look us up there. And then if you're interested in different investment types, different products, you can reach out to us too. We have developments going on. We do have a big duplex development happening right now that people can get involved in too.
Cool. Awesome. Ryan, thanks for coming and hanging out with us here on the DoorGrow show.
Thank you, Jason, for having me.
Awesome. Okay, so for those of you that maybe you're struggling in your property management business, reach out to us. You can check us out at doorgrow.com. And for free training on how to get unlimited leads for free, text the word leads to 512-648-4608. Also, be sure to join our free Facebook community just for property management business owners by going to doorgrowclub.com. And if you want tips, tricks, ideas to learn about our offers or any of that about DoorGrow, subscribe to our newsletter by going to doorgrow.com/subscribe. And if you found this episode even a little bit helpful, don't forget to subscribe and leave us a review. We'd really appreciate it. Until next time, remember, the slowest path to growth is to do it alone. So let's grow together. Bye, everyone.